On October 29th, the Bank of Canada lowered its main interest rate, known as the overnight rate, down to 2.25. You've probably seen all the headlines, but what does this actually mean for you, for your clients, or the real estate market as a whole? Let's break it down. The overnight rate is the rate Canada's major banks use when lending money to each other. It might sound like something that only happens behind the scenes in the financial world, but it actually creates a huge ripple effect across the entire economy. When the Bank of Canada adjusts this rate, lenders almost always respond by changing their prime rate, and that's the number directly tied to variable rate mortgages and lines of credit. So when the Bank of Canada cut rates last month, anyone with a variable rate mortgage likely saw their interest rate and possibly their monthly payments go down. That's immediate relief for some homeowners, and it often improves confidence for those considering a purchase. Now here's where things get interesting. Fixed mortgage rates don't move directly with the Bank of Canada's overnight rate. Instead, they're influenced by the Government of Canada's bond market. When bond yields fall, fixed mortgage rates usually follow. When yield rises, fixed rates tend to climb too. So even though the Bank of Canada rate cuts don't automatically reduce fixed rate, it often sets the tone for what happens next. If investors believe that the bank will keep cutting rates or that inflation is cooling, they typically move more money into bonds. That added demand pushes bond yields lower, and lower yields often mean cheaper fixed rate mortgages. So why did the Bank of Canada cut rates this time? In short, inflation continues to cool, consumer spending has slowed, and economic growth is moderating. By lowering the overnight rate, the bank is trying to stabilize the economy while easing some of the pressure Canadians have been feeling, particularly those carrying variable rate debt. So what does that mean for the housing market? Lower rates tend to boost confidence among both buyers and sellers. Buyers who are sitting on the fence might now find themselves in a stronger borrowing position, and sellers could start seeing more activity, especially if lower rates bring more qualified buyers back into the market. In short, lower rates can help get things moving again, and we're already seeing early signs of that here in the Fraser Valley. Looking ahead, many economists expect one more rate cut before the end of 2025, depending on how inflation trends over the next few months. For those with a variable rate mortgage, that would mean a bit more breathing room. For fixed rate borrowers, it really depends on what happens with the bond yields, which have been volatile lately but could drift lower if the economy continues to soften. So to sum it up, the Bank of Canada's rate cut is a positive signal for homeowners, buyers, and real estate market in general. It's given variable rate borrowers some relief, improving affordability for new buyers, and potentially setting the stage for more activity as confidence returns. If you'd like to know how these rate changes affect your specific situation, whether you're looking to buy or sell or refinance, I'd be happy to walk you through your options.